Hello, everyone, and welcome to another episode of the Wright podcast, your one stop destination for understanding the complex world of economics and finance. I'm your host, Suram Srivastava, and joining me today is one of the most special guests on the podcast. I have Ankita Pathak joining me, who's a macroeconomic guru and an influential voice in India's financial world. Ankita currently leads products and macro as DSP investment manager, and she's a celebrated economist known for her expertise in top-down investing and her deep understanding on how macroeconomic factors affect the financial landscape. She's been a Commonwealth Scholar at the University of Warwick, and she has been quite instrumental in driving meaningful investments, making her mark in prominent financial institutions, and even contributing to policy advisory in the NITI Aayog. So today's topic is, how does inflation cycle affect the stock market in India? We'll understand how the nuances of inflation affect our economy as well as the stock market. We'll explore the evolution and the key contributing factors to consumer price inflation. We'll see how the cost of capital is impacted, how that impacts various sectors, how does the commodity prices and other global macroeconomic factors also impact the economy. So it's going to be a very, very interesting talk. And I invite you to stay tuned and get into the rabbit hole of macroeconomics and understand the complex interplay of inflation and the Indian economy from one of the most celebrated experts in this field. So let's start. All right, Ankita, welcome to our podcast. And let's get started with these questions for you, right? So the first question I have for you, Ankita, is something that a lot of us hear about, but we lack the in-depth understanding of, right? So the first thing is, what is the current state of inflation in India and how has it evolved over the last decade, right?
Sure. Uh, Thanks, Sona, for having me.
Yeah.
Always a pleasure to talk on inflation, I guess. Been the talk of the town for last 6-8 months, got us scratching our heads and guessing the policy action for sure. But as you rightly said, I think to look into the future, it's important. It's very much needed that we look in the past as well. And inflation has not always been an India's problem, but definitely has been India's priority. Okay, so if we start from great financial crisis, and all crises are marked with a fall in inflation because suddenly there is no demand and inflation, cost corrects itself, commodity prices fall, and as soon as the recovery starts, inflation just jumps up. So that happened after the GFC, that happened after the COVID as well. So let's go back to 2008-9. We were like having that steady inflation, then the crisis hit, we went to low inflation, and when we started to recover, oil touched 100 back then, it was big. And then we started to have high inflation. Come 2012, we had this taper tantrum by the Fed when it started to say that I've been injecting about $85 billion every month and I'm not going to do it anymore. At that time, India was clocking double-digit inflation, probably because of the two factors. One is very high food prices globally, and India at that time was giving very high minimum support prices. So we had high global inflation and we had domestic policy. The government wanted to push rural India, so extremely high MSP. Result was high food inflation. And secondly, the oil prices, as I said, had touched 100 above. So fuel inflation was also high. The food and fuel combined were contributing to India having like a double-digit inflation. And I think that's when we saw the regime, shift a bit. The then governor continued to hike rates. We lived in liquidity deficit, and I think inflation course corrected itself until in 2016, RBI explicitly adopted the FIT, flexible inflation target framework, where we said right now 4% on the headline is our midpoint and plus minus 2% is what we feel comfortable with. We did, I think, compromise our growth a bit by doing so, but I mean, that's separate. We definitely did take a stance on having a lower inflation. The government that came into the power after was also inclined towards a lower inflation. So we instead of having a fiscal deficit of about 5.5%, we suddenly started to be very conservative and move very quickly towards 3.5%. So between 2016, 17, 18, 19, we were trying to curb our fiscal deficit and make sure inflation remains in the target range. We were deficit on liquidity, and I think that all that played out to an extent that India's inflation has even clocked like 3.5% in that time. I think back then I would have said that maybe India could do with a little more inflation because that's good for the growth. But before we could, come to that, COVID struck us, and things went back to first few months of low inflation, and then inflation just putting up the roof, and we seeing some of the highest readings we've seen in India. I think we went up as much as 7.5% in this cycle. Again, two reasons. One was, of course, the global commodity prices, and secondly was COVID was different. COVID was different than global financial crisis because GFC, only the demand suffered. In COVID, the supply suffered. So just, supply just didn't come back in time. And just when we had started to recover, we had the Russia-Ukraine war. So that was another dent to the whole situation of us getting back into control inflation regime, and then oil goes up. So the inflation has been sticky, such stuff around, partly due to one, high commodity prices, and secondly, high service prices, because you curbed the human race and told them you can't do anything. The moment they were allowed, like the recreation activities, education, personal care, all of that, inflation has been very, very sticky. And you and I can actually feel we are paying more for services. We are paying more for airfares. We are paying double of COVID for airfares, to be fair. So all of that culminated into a sticky inflation. So I think I'll just wrap up from stable inflation to post-crisis inflation after 2008, then taper tantrum, then India adopting flexible inflation targeting and choosing a low inflation scenario, then COVID, where we were low, but then got struck by the global factors. And as we stand today, I think inflation will ease here on. So we might see another few years of falling inflation ahead of us.
Right. So I think that's a very good summary of our journey that has been with inflation in India. Now what I would want to understand from you, Ankita, is that what are the different factors? Like you talked about the global economy and the commodity prices, but what are the other key factors that sort of impact the inflation trajectory in the Indian economy?
Sure. So Indian economy is 45% food prices. The headline CPI basket is 45% food. So I think nothing matters to us as much as food does. Food and fuel together is about 52%. So that's the major chunk of our basket. What affects us is, of course, the global food prices, the domestic calls, the MSPs that we want to have, the monsoon outlook that we have. In terms of fuel, there's literally very little that can be done domestically. It's all about the international fuel prices, except for the government does step up and reduce their excise duties a bit, keep the pump prices in check. So food and fuel, because it contributes 52% to India's inflation, is what matters today the most. But and therefore we look at core inflation, which is the inflation minus food and fuel, to see the domestic structural inflation in the economy. This number usually was much lower than the headline inflation. But this time around, even this number has been very tricky because, as I said, the services sector is doing well. Partly doing well, partly consumers don't have a choice. Like if you look at air travel, there's literally so little choice available that people agree to pay those higher prices. So I think this time around, services inflation has also been sticky, apart from the regular food and fuel, which are the concerns.
Right. So when we say headline inflation, you mean the food and fuel, and the rest of it forms the core inflation, right?
The headline inflation is the basically the headline that you see in the newspapers. It's the CPI, Consumer Price Index Inflation. So that is core plus food and fuel. So like the 6%,
Right.
or what in RBI is trying to target at 4% is your headline inflation.
Right.
From that number, you remove the food and fuel inflation, what you reach.
Got it.
Core inflation.
Yeah. And for the fuel, obviously the global, because we are importers of fuel, so the global oil prices will impact it. And for food, monsoon as well as other commodity prices might be.
Yes, MSPs and also the global prices. I mean,
Right.
wheat and all are like globally traded. So if in the
Yes.
Ukraine war, the bread basket of
Right.
Europe has suffered, and suddenly it's passed on to India in wheat as well. So that also matters. The global factors also matter.
Right. Right. So obviously, inflation has a big impact on the purchasing power of customers, right? And also on their investment decisions, right? If things are getting expensive, then my savings will become lower, right? So what impact do you think that consumers have, due to inflation?
For sure, the first round effects that you said, that purchasing power falls down. So you have,
Right.
if you were to keep your needs constant, you're just gonna pay more for your needs. So your discretionary expenditure will suffer because you
Right.
just have lesser left, and
Right.
usually the savings do that. But I think this effect also fades out a bit. Reason being that wage follows inflation. Okay, so there's something known as wage inflation. If the inflation is persistently high, employers are forced to also give higher wages, which is possible for them because they are also making higher revenue. So inflation is something which kind of reflates the whole economy. If you were, used to seeing everything as 10, you suddenly start seeing it as like 15. So because nominal GDP is higher, the revenue of the companies is higher, and at some point that percolates down into higher wages, and therefore which again leads to more inflation because people will now pay more so for the same goods. So it's kind of a vicious circle with inflation, but definitely it does bring down the consumption is discretionary, and it does bring down your appetite for savings in the first year. Over time, the course corrects itself as your wages adjust.
Interesting. So obviously, we've all been, it's a very complex thing that, I think all of us have been tackling, right?
Yeah.
Now we talked about individuals and, how their, or consumers, how their decisions are impacted by it. But you also talked about companies, right? So how does inflation impact the cost of capital for companies? And like you said, the revenues also get better. So what is the implication for, various companies in the market? This means.
Sure. So let's start with, simple thing that we all know, that high inflation usually leads to high interest rate because the central bank will step up to, control it, which means that there is high cost of capital for the company. Okay. It also means because there is high inflation, there is higher raw material input price cost for the company. At the same time, there is higher revenue. Because if they were selling 10 cars for 10 rupees and they're now able to, sell 10 cars for 12 rupees, they've just seen a 20% jump in their revenue with the volume being big. So there is no one answer to this, is what I would say. It depends on sector to sector, company to company. At any point, if the increase in revenue is more than increase in cost, the sector becomes favorable, and that's where investors run through. At any point when the cost increase is so high that their margins are shrinking, the revenue is not able to keep pace, then that sector gets negatively affected by high inflation. Now, first case, we know why it happens, because of course prices are up. The second case happens that revenue hasn't gone up is because these companies do not have the power to pass on the price to the final consumer. So it could have happened, there's high inflation, but there is not enough auto demand in the economy. So you can't really increase prices of cars by 20%. That's not possible. So you have to One sit with high cost of capital, high raw material cost, and not pass that on. So your margins are getting, shrunk by doing so. And that is negatively affecting your profitability. And also when the turnaround happens, so when commodity prices have corrected and you're still sitting at a higher price because of higher inflation, you may decide not to cut the price. And now your input cost has fallen, but you think there's enough demand, so I'm not going to cut the price to the consumer because the consumer had adjusted itself to this price, and then your profitability goes up. So all these are possible scenarios. It's anything is possible, and one needs to actually look at the company calls, the decision that company has taken on how much price to be passed on, and how much price they'll actually take a brunt on their margins. What's the demand for this sector? What's the raw material? How much of raw material cost is going up? How much of cost of capital is going up? So I think it's a very comprehensive study, but these variables need to be kept in mind while doing it.
Right. So that brings me to another very interesting question for you, Ankita, that, how do you think, and that is something that, a lot of investors sort of want to know, that how does this cycle impact the stock market? And I know that you take a top-down decision on the economy when you work on your investments, right? So how are you looking at, various sectors in terms of the impact of inflation in the current market? And this will be a very interesting insight from you.
Inflation on company valuations, and second is the effect of inflation on companies' profitability. Okay? In terms of impact on the valuations, low inflation leads to higher valuation. So when Nifty was trading at 32 times PE, our repo rate was 4%. The moment we started hiking, it self-corrected itself. Why? Because when you do all these valuation models, you look at something known as discounted cash flows. So when inflation is low, interest rate is low, the value of future cash flows as of today look higher, which means that you are able to give a higher valuation premium to the companies and to the stock markets in general as well. So low inflation, low interest rate, higher valuation. That's one part of the analysis. The second part of the analysis was on the profitability of the companies and sectors, and that we've already spoken about in the answer to the last question, that it's a mix of understanding whether this sector in a higher inflation or in a lower inflation will be able to increase its profitability. It is possible as a balance between the cost of capital and raw materials and the revenues that it is. So the sectors that are doing well or are increasing their profitability, of course, become more favorable. And when the cycle turns, so when inflation eases, the sectors who had raised the prices in the past cycle become additionally favorable, because more likely than not, they will not cut the prices. But the cost of raw materials and interest costs has eased for them. So that is a very individual company level analysis. But overall, if you're looking at stock markets, we can't really say that inflation is bad for stock markets. It can be good.
But the cycle also impacts the, like you said, right? And now that we've reached that point where inflation is coming down and maybe interest rates might also come down, so the whole trajectory will again shift, right?
Sure. The cost of capital, etc., will start to improve, and therefore, as I said, the sectors which had like commodities as the input, autos, FMCG, where oil is used as an input, etc., those will benefit because the final price to the consumer doesn't change so much.
But what about the banking and the financial sector, who actually gain from high interest rates?
They do, because high inflation, high interest rates, that means that their net interest margin, NIMs, go up. NIM is the difference between what banks pay when you take a loan, what banks pay you for depositing money with them. So if the repo rate is higher, the interest rate is higher, and the cost of credit goes up, which is essentially earning for a bank.
Yes.
If I'm correct, somewhere at 11% in India right now versus pre-COVID of 8.5%, 9%. So
Right.
that is a net increase in profitability for the bank.
So if the inflation trajectory sort of corrects and the rates also correct, does it impact the banking and financial sector as well?
It does for sure, because that means that they will have to bring down the cost of credit, because we have most of our loans as floating rate loans. At the same time, they can't really pay much lesser to the depositors, because you need the deposit creation for banks to actually be able to lend. So deposits are important. To protect the deposit, they might not be able to cut rates on deposits, but they'll have to cut on credit. So that does affect the banking sector's profitability when this inflationary regime turns.
All right. So we talked about the impact of inflation and how it's impacting the various sectors. And I am sure, Ankita, you must be quite well aware on how the cycle is going to turn. You might be able to predict it better than others. But how do you think that if we could talk about the tools that the monetary policy has and the government plays in the next part of the podcast? So I would start by asking you, how does RBI sort of take its inflation correcting decisions, and what all tools do they use?
Sure. So I think it's central bank's major mandate to look at price stability in the economy.
Right.
One thing I will give it to this NPC, especially to the governor, is that they've been very prudent with not getting overburdened with inflation alone. Also remembering that we are coming out of a crisis and we are a weak economy at this point, so it does need some support. We did hike rates by 250 basis points, but I think we did it very timely. We didn't rush it just because inflation was high, which is good because they're trying to manage inflation and growth. Now, what can RBI do? RBI can increase interest rates. RBI can suck out the excess liquidity, reduce the money supply, and that can be done through various, reverse repo rate options. RBI cannot inject more money, so it cannot do like open market operations that brings in more liquidity in the system.
Right.
So those are the 2-3 instruments: liquidity control and the interest rate cost that RBI maintains. On the fiscal front, revenue inflation is revenue expenditure is inflationary, not the capital expenditure. Okay, so if you do less revenue expenditure and do more of capital expenditure, you are already helping inflation. Don't give too many subsidies. Don't increase the MSPs by too much. All these are steps towards controlling inflation, and I think fiscal can actually do a lot, in a sense that it can keep the pump prices constant. It cannot let the pump prices go up when the global prices are going up, take a hit on their balance sheet, which they do. So I think if monetary policy and fiscal policy work in tandem to control inflation, we will reach there. There is no two ways around it. We have very comfortable forex reserves. We have very solid level of debt. I mean, it's not extravagant debt that we are very stable as an economy. So monetary policy through interest rate, liquidity operations, and fiscal policy from curbing on revenue expenditure, doing more of capex, and taking targeted steps. Whichever side of inflation is going up, that can be cut directly by the government. Helps tackling it.
Yeah. So like I think the capex cycle has increased through the government decisions in the latest budget, right? That's also one of the calls that they have sort of taken.
Yeah. So I think that was a conscious call. When capital expenditure goes up, you employ people, you create jobs. Okay. When the expenditure go up, when you grow a subsidy, it's like a fee. There is no asset that's getting created. So that becomes inflationary, because suddenly you're sitting and you have more money, which you didn't have before. But here you have a job and you earn money, and there are assets getting created in the economy as well. So in doing capex is definitely less inflationary, and in a high inflation scenario, pushing towards capital expenditure, I think that's a good policy call that you've taken. And I think
Right.
I definitely think that we are already down on inflation, and we go further down in the coming.
Right. Right. So obviously we talked about the monetary policy as well as the fiscal policy. But obviously, in the recent times, if you watch out for it, I think monetary policy in India as well as the US have been the biggest drivers for the stock market, right? Those are the news that impacts the prices the most. So what is the impact of these policies on the stock market that you would say?
Sure. So there are two things that I would want to highlight there. One, pre-global financial crisis, nobody cares about policy because they said that markets are efficient and they will find their balance. Okay.
Right.
After that, we've had so many of these small events where policymakers have said that markets actually look forward to policy.
Right.
There's more narrative around what Fed is doing than there has ever been. The second point I want to make here is that markets only react to surprise in policy. They don't react to data as if you expected RBI to deliver a pause,
Right.
RBI delivered a pause, it's a non-event for the markets. They go ahead. But in the expectation that RBI will hike and RBI has delivered a pause, that's like super dovish, and both bond and equity markets tend to. In terms of thumb rule, both bond and equity markets, I think, like lower interest rates for obvious reasons. For equity, lower cost of capital, and for bond because it keeps yields lower and allows capital gain on more. So, thumb rule, lower interest rates, dovish policy makes us happy. But the caveat is that if that is coming because growth is very low, that means that you wouldn't have enough revenue. That's a bad sign on the economy that central banks cutting rate because inflation and growth are super low. That's not something we like. So lower inflation with a middling growth is something where our sweet spot lies.
Right. I think there are two complex scenarios at play here, right? One is inflation, and then you have the interest rates, and their interaction also creates like a lot of commotion in the market. So how do you think the interaction of inflation and interest rate comes into play, and how does that impact the investors?
Sure, I think interaction is very simple. If your inflation is above 6%, RBI one meet or the other will be forced to increase interest rates because that's the only way you can put a check on the domestic demand and create inflation, check on the expectations of the household. So very high inflation leads to higher interest rates, lower inflation tends to lead to lower interest rates. The other third variable in this, of course, is growth. You cannot ignore growth at all. So if you're having, very low inflation and very low growth, then you might have to rates further. And if you are having like, high inflation but low growth, it's stagflation. In that case, you can't really increase interest rates a lot. You'll have to keep that in check. That's important.
So you talked about the policy in India, and it looks like we are at a high growth and we are at a cooling off inflation. What about the US? I think in the US the rates are still high, and
the rates in US are high, and I think the governor in the recent policy just bought him more time when he said we are pausing now, but we may hike in future. But I think they wouldn't get a chance to hike in future because inflation will cool off. They are sitting on an inverted curve. Growth projections are not looking too strong for US economy. So I think it will be like a pause phase for the US economy.
So do you see a fear of a recession or a stagflation happening in the US economy?
I see a fear of a recession? Yes. Stagflation? I don't think so. I don't think so. They're able to sustain high inflation.
Right. Okay. So yeah, obviously, the global macroeconomic scenarios plays a huge role, right? Indian monetary policy and fiscal policy can only do one bit, but a lot of it is coming from the global scenario as well. So why don't we wrap up by talking a little bit about how these global macroeconomic forces, from oil prices to currency exchange rates and the Fed interest rate, impact the inflation as well as the stock market in India?
Sure. So I think all of this matters because they are the lead indicators of inflation. So if commodity prices are going up, oil prices are going up, know that India will have inflation. Similarly, if Fed is hiking rates, if India doesn't hike rates, that means that money can flow outside India, which means your currency will depreciate, which is something we avoid. If Fed is hiking rates, the chances of India hiking rates are very high. If your USD INR is depreciating, that means that your imports are becoming more expensive. About 12-13% of our inflation comes from imported goods. So suddenly our imports are becoming more expensive. That means that the domestic inflation will also go up. All of this, high oil prices, depreciating currencies, high commodity prices, high Fed rates essentially means high inflation and high interest rates in India. And it's not something that, stock markets generally like. We like, as I said, we like lower interest rates and middling economy and not high interest rates alone. But having said that, I think stock markets are more about those company level analysis that needs to be done, because there'll be certain companies who, despite the high inflation, are able to increase its profitability because the revenues are so high and the cost of debt or the cost of raw materials is not affecting them. So macro speaking, these are all slightly negative tones to the Indian markets. But we could live in a time like we're living today, where India's growth is so strong that it does affect us, but it doesn't affect us as much as it could have possibly done when we were very vulnerable, let's say in 2012-13. Today, we are not that vulnerable. We're not a fragile economy. We have solid domestic demand as well, and therefore the effects are muted.
Right. Perfect. So I think this was really insightful, Ankita. You simplified our understanding of these complex topics a lot, and I think this would be very useful for our listeners as well. Ankita, where else can we follow your research and your insights if our investors wanted to?
Sure, thanks, Sonam. I hope this adds value, and we regularly write products such as Netra, Navigator, 5 things that where we talk about all the macro regime that's available on the my Twitter handle of EMF, our website bsbim.com. So all of those can be tried.
Perfect. So we will also attach all of this here. Thanks a lot, Ankita. This was really, really insightful.
Thank you. Thanks a lot for having me.
Thank you. So that's it for today's episode of the Wright podcast. A big thank you to Ankita for sharing her expert insights and shedding light on the intricate dynamics of macroeconomics and the inflation cycles in India. Her deep understanding of the subject matter has actually enriched us, and I'm sure that the audience found this discussion extremely valuable. Let's remember that the understanding of inflation and the role it plays in the economy is important not just for investors, but for anybody who's looking to grasp the broader picture about the Indian economy. Ankita has shown us how the global and local factors interplay and impact our markets, how the monetary policy impacts our stock market, as well as how the fascinating and complex world of finance works. So make sure that you join us again next time for another insightful discussion where we'll continue to unravel all these intricacies of the financial world for you. And let's make sure that we make informed decisions. We do our own research and consult our advisors before we take a call. And please don't forget to subscribe to our channel and hit the like button so that we continue to bring on more such insightful episodes for you. Happy investing.